Guys, the Buffett meter, it just hit 223.8%. And if you're still in the market, this matters. It is the highest on record, putting us 60% above GDP. And this is deeper into crisis territory than March 2000. Last time we saw numbers like this, the market lost 49% over the next 30 months. So if you're holding stocks, REITs, or betting on flips, this is not market noise. It is a flashing red light for your wealth. And in this video, I'm going to show you why even smart investors are getting blindsided and how one tech founder avoided disaster by switching to a completely different system. Let's start with what this spike really means and why this time it just feels a little different. This is not about market timing. This is about market structure. Warren Buffett's favorite metric just screamed bubble territory, louder than it has in 24 years. Think of the Buffett Indicator like a car speeding down the highway. When it hits 150 miles per hour, the engine is purring. And at 206 miles per hour, the transmission is smoking. And at 223.8, you're not just going too fast. The road's getting narrower and the exit signs are disappearing. Translation, every dollar that you have in traditional investments is betting against gravity. But here is the real problem with Wall Street investing. You have zero control. Think about it. Your portfolio goes up or down based on what Jerome Powell says at a press conference, or whether Elon Musk tweets something at 2 a.m., or some analyst in New York downgrades a stock that you own. And you're not able to call Tim Cook and ask him to boost Apple's earnings. And you can't influence whether China opens or closes their economy. And you can't control whether the media tries to panic about inflation or ignore it. Your wealth is tied to the emotions and opinions of millions of strangers. That is not investing. That is gambling on human psychology. So if Buffett's danger meter turns out to be right, you need assets that you can actually control. Assets where your success is not determined by someone else's sentiment, where you can walk up and touch it, improve it, and directly influence the outcome. That is why smart money has been quietly moving into real estate. Not because it's trendy, but because it's controllable. You own the property, you choose the location, and you decide on the improvements. You set the rent. And here is where most people screw it up. And right now, millions of investors are making the same fatal mistake that Megan made. Megan is 32 and she's a tech founder. And her net worth is on its way to 8 figures. And on paper, she is absolutely crushing it. Last year, she flipped a fixer-upper in Austin. And she made $187K in 8 months. And that first win, pure adrenaline. But she wanted more. So she levered up for deal number 2. Bigger property, bigger upside. And then reality hit. Construction delays, and I see this all the time, pushed the project from 4 months to 11 months. And budget overruns just chewed into all of her profits. And the contractor disappeared for 3 weeks with her cash. And now she's holding a half-finished property, bleeding 8 G's a month in carrying costs, watching her credit score drop while all her investors and lenders are asking some really uncomfortable questions. Do you know somebody like that? Has this ever happened to you? And you might be thinking, that's just bad luck, right? Wrong. Most flippers do make money on their first or second deal until they don't. Megan wasn't unlucky. She just hit the 3 invisible killers: contractor delays, cost overruns, and the fact that she was personally liable for everything. And here is what no one tells you about traditional real estate investing. Flipping is a job. You are simply trading time for money. And one bad contractor, one bad project can completely wipe you out. According to Adam Data, home flipping profit margins have hit their lowest since 2008 at 25.1%. REITs are diluted. You own a fraction of a fraction of a fraction, paying management fees on money that's already been marked up. And REITs average only a 5.5% return over the last decade. And syndications right now with interest rates are simply gambling. You're betting on somebody else's deal with somebody else's timeline, hoping, begging they don't screw it up. But here is where it gets personal. What if there's a market inefficiency that's so obvious that $47 million in assets have already moved there? And most investors still don't know that it exists. This is what Megan discovered, and it changed everything for her. Instead of gambling on her next flip, she found something called direct ownership syndication. And here is what she discovered was possible. You can own property 100%, no dilution, no management fees, no middleman taking their cut. But instead of doing all the work yourself, you found operators who do all the heavy lifting for you while you keep full ownership. And some of these operators have access to institutional financing rates currently around 5 to 5.3% versus the 6% plus that most individual investors pay. And instead of dealing with contractor roulette, certain groups have in-house construction teams, fixed costs, fixed timelines, and no budget surprises. Megan found an operator like this. Her first property, cash flow positive in 47 days. $2,800 in monthly rent on a $180,000 investment. That's an 18% gross cash-on-cash return before taxes, maintenance, and management expenses. While she was able to put her focus back on scaling her tech company. Her numbers don't lie. Her portfolio return, 14.3% annually. And the time she spends, less than 2 hours monthly. And her stress level, practically zero. And compare that to the S&P 500, 12.5% annualized over the last decade, with 30% drawdown risk always hanging over the investor's head. And now this approach, it's not widely advertised, and it's actually hiding in plain sight. And most people have never heard of it. But for those who find the right operators, the results speak for themselves. Last month alone, one group closed 23 properties for their clients. And the average time from purchase to cash flow, 52 days. An average monthly return per property, $2,400. And that is not speculation. That is what happens when you find the right system. But here's what most people, they just don't understand about this approach. The biggest opportunity, it's not about avoiding the next market crash. It's positioning yourself while everybody else is panicking. When traditional investments crater and the Buffett Indicator, it says they will. Direct ownership becomes a safe harbor for smart money. But there is a specific way this works that most people miss entirely. And that's why I pulled this video out for you to watch next, because it shows you exactly how direct ownership with preferred financing solves all three problems that we just talked about. The middlemen, the markups, and the management headaches that keep people stuck with diluted returns. I'm gonna show you the exact numbers, the financing structure, and why your money compounds so much faster this way than sending it to Wall Street.